Hi, this blog is about professionalism, specifically actuarial professionalism. I presented at the Underwriting Collaboration Seminar in March of this year on this topic with a couple of other people, and I wanted to give some thoughts and some of the thoughts of the audience. I wasn't responsible for the content. Indeed, I thought it was too actuary focused for an audience that included many underwriters. Professionalism sessions are popular because they help fulfill the continuing professional education or CPE requirements, but they can be extremely dry. There's only so many times you can read through the Actuarial Standards of Practice, ASOPs, even though there is a lot of wisdom in there. By the way, and this is not the CAS or AAA talking, I think the professionalism can be boiled down to one line, and again, this is just me talking, and that line is, if you're in doubt about something, ask the ABCD. The ABCD, or the Actuarial Board for Counselling Discipline, is a group of highly seasoned and respected actuaries that will advise you for free on professionalism issues. I'll give a personal example. I've only used them once. I passed my exams quickly. I also had about 4 exams before I started my job, my first job. So I got my ACAS before having the requisite 3 years experience to be an MAAA. This raised a host of questions about actuarial communications. I can only see this question getting more playtime as actuarial science programs become more popular, and therefore people will have passed more exams before getting their entry-level job. In addition, you can take preliminary exams every 3 months now, and when I was taking them back in the day, you could only take them every 6 months. So anyway, I asked the ABCD what to do, and they put me in touch with Michael Toothman, who is a past president of the CAS, a very well-respected actuary, and an all-round great guy. And he had the same issue, actually, when he was starting, and we discussed the options and came to a good solution. So I want to just start off by giving a big shout-out to the hard work of the ABCD, and this is perhaps the single most important part of the AAA. Membership dues well spent. As I said, professionalism can be kind of dry, so actuaries invented snappers, which are based either on events that happened or events that could happen in a range of circumstances. In general, I find that the answer is often nuanced, whereas the snappers can be pretty general, and oftentimes when I hear them, I want more specific information. I think some of the snappers indeed are written with the idea that many different circumstances could lead to different answers. Maybe they can be improved by having the presenter give more specific facts. I kind of feel like I'm shooting in the dark. Anyway, I'm presenting a snapper that actually happened to me when I'm at KMAR next week, so we'll see how that goes. I'm also going to be presenting a number of other snappers, so we'll see how that goes as well. Maybe I'll make up facts on the spot and say, well, if this happens, what if this happens, and we'll see how that goes. So there were 2 snappers in our professionalism seminar at the Underwriting Collaboration Seminar, and the first one went like this. So there's an actuary manager, and there is what I'll call a junior actuary, and the junior actuary does most of the filing work, but in this case the actuary manager is relying on a non-actuary for the rate filing. The junior actuary isn't comfortable with this since he can't follow the non-actuary's documentation and he wants more time to look at it. The actuary manager doesn't want to give this time because he wants the rate filing to go ahead. So the actuary manager signs off. Normally the junior actuary would do it, but in this case the actuary manager signs off as his signature. Lo and behold, a few months later, the Department of Insurance has questions. What do you do? So my feeling was, and I don't think anybody disagreed with this, that the junior actuary was in the absolute clear. He was uncomfortable, so he didn't sign off. Like, what else should he have done? Report his manager to the ABCD? So I didn't see any controversy in this at all. Similarly, the non-actuary isn't bound by actuarial standard of practice, as far as I know. So I think they're in the clear as well. Also, since in the scenario they went for a job in academia, like the ABCD's scope of discipline in this area is kind of limited. So, back to the actuary manager. Firstly, A, did he do anything wrong? And secondly, B, what should he do now? So my thoughts, and this is guided by some comments that were made by the audience, are that there are ASOPs. In terms of what did the actuarial manager do wrong to begin with, there are ASOPs actuarial standards of practice about actuarial communications. The big one is ASOP 41. There were guidance scattered about in other ASOPs, especially in this case, relying on non-actuarial work. The actuary manager signed off on a rate filing based on non-actuarial work by a non-actuary, apparently without understanding it to a great extent. So I'll say in my experience, I've reviewed hundreds of rate filings on behalf of maybe a dozen departments of insurance. And in my experience, the regulators are big picture thinkers. They're very good at their job, normally have a lot of experience. So in my experience with the regulators, in this case, in terms of what to do next, if you give them a lift chart, that's the change in how much people are going to pay the change in how much each person is going to pay. You give them the overall percentage movement, and that's actually required in most departments of insurance's documentation to do a filing anyway. SERF has a special box for it, SERFF, I forget what it stands for now. If you do some explanation as well of how you're going to cap the raises, so no one's going to get 100% raise based on going to this predictive modeling type filing. And if you give some kind of general approach to how the work was done, that'll get you there. So saying that it was done by this person who has a PhD in this, and they used these models with these parameters, I think that'll get you there. I don't think, in my experience, departments of insurances are going to ask you to justify every parameter, provide evidence for every parameter, have VBA printout of exactly how you did it, etc. In my opinion, the actuary manager should know all of this before signing off anyway. From a business point of view, if not an actuarial view, how can an actuary manager in good faith sign off for a rate filing for his company without knowing what effect it's going to have on the premium levels of his book of business, at least in an overall percentage rate, possibly by region if it's a national program, etc.? And if he states in the filing, in the original filing to the State Department, that he's relying on the non-actuary and he hasn't reviewed the model in tremendous depth, only from high levels and explained, I think a lot of DOIs will be okay with that. And obviously that's going to depend. It's going to depend on the line of business. It's going to depend on the overall increase. It might even depend on the individual DOI. So, for instance, if you go to a new predictive modeling basis, and this is going to be the justification for a 50% premium increases on coastal homeowners in Florida, that's not going to fly. But if you're doing it for some kind of business liability insurance, and you can show that you've had bad loss ratios in the past and there's going to be a modest raise, then I think most DOIs are going to be okay with that. And by the way, in the situation, in the scenario that has been pointed out, I would expect the actuarial managers upstream to give this guy a much bigger grilling than the DOI. I'll say myself that I have worked, as well as working in consulting for most of my career, I have worked in industry. I have delivered the news of big premium increases, etc. And my upstream and the business in general has been very interested in understanding why and the reasons for those changes and justifying it based on previous losses or what we're seeing in the market in other areas and on perceptions about the future and so on. So upstream does care about these things, and I think the actuary manager, again, is going to be in more trouble with his upstream if he hasn't got his I's dotted and his T's crossed than the DOI. So the second snapper was about actuaries in non-actuarial positions. So the basic story is like this. There's a traditional actuary who gets promoted to a senior non-actuarial executive role. I think it may have been some kind of executive underwriting role, and then argues with the actuary that took her job about rate indication being higher than she thinks is warranted. The arguments presented in the snapper appear to center on what I would call actuarial issues rather than marketing issues, if that's relevant. So, for instance, what the trend should be, how you're going to justify and calculate that trend, changing claims handling, etc., 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 rather than saying that's too expensive because our competitors are charging less than that, which is I'm not saying is not an argument, but it's a different argument. So, what should the actuary, who is now an executive, do, and what should the new actuary, I'll call it, do? So it's a good question. I'll just say personal example from my career that when I worked with industry, I worked a lot with the chief marketing officer, the CMO, who had a flair for math, although but had never taken an actuarial exam. He was much better at math than you may expect a CMO to be. I know that's changing in the world as analytics gets more important, but this CMO was extremely bright and talented. I think he'd done some finance work in the past for people, so he had a flair for math and understood what was going on actuarially. He was also 2 levels above me, at least, depending on how you calculate the hierarchy. So it could have been awkward. Obviously, I'm there as the actuary trying to get the rates that were needed, and he's the CMO and could have interpreted that to mean getting us, promoting sales and so on. But he was very respectful. I was very lucky about that. And there were some very isolated cases and pretty minor cases where we couldn't actually agree ourselves on a compromise, and then he would go with me to my boss, who was the head of risk, who would offer me the tiebreaker. As I remember, I'll say that the tiebreaker normally decided in favour of the CMO, not in favour of me. So there you go. I still had a lot to learn, obviously still do. So in this case, anyway, in this snapper, I think it partly depends. I argued, I was sitting at the front because I was acting out some of the roles. I argued it was partly dependent on the status of the executive. Have they been keeping up with the CPE? Have they been out of doing any actuarial work for 7 years and are completely rusty, etc., and they're just remembering things that they did in their career? So there's a lot of different issues. The snapper didn't get into that, etc. One member of the audience argued with me and was basically saying that, well, you need to listen to the arguments anyway. I agree with that. Even if a non-actuary gives you good arguments, you need to listen to them, give them the time of day, listen to them, consider their arguments. We're all trying to get the right number over here. I think the general consensus was that the new actuary should consider the executive's arguments very closely, since they are or were, at least were, a skilled actuary. Often executives have a bigger picture and may be thinking of things that the traditional actuaries don't. But if the new actuary can't get comfortable, then I don't think they can sign off on it. And I think that was the consensus. Also, it was unclear in the snapper who the new actuary was going to report to. If it was to a different executive, like the CRO, for instance, then I think it's a clear case where you would just discuss it with your boss. And of course, as I said before, if that's not an option, then discussing with the ABCD, it's confidential. I'm not on the ABCD, I'm not getting paid to promote them, but I think they're a wonderful resource and an underutilized resource.